You don't have a pension. Most people your age don't. So when someone brings up the pension crisis, your brain probably files it somewhere between interesting and not my problem. And that's exactly the reaction that makes this so dangerous. Because the pension crisis isn't just a retiree problem. It's a markets problem. And it's quietly becoming everyone's problem, whether you have a pension or not. Because right now, the people managing trillions of dollars in public pension money are making increasingly desperate bets in financial markets just to keep the math from falling apart. And when they get it wrong, which history suggests they will, the fallout doesn't stay contained to some municipal building in Illinois. It bleeds into asset prices, credit markets, and tax bills. It bleeds into your retirement account. And it bleeds into markets that have absolutely nothing to do with pensions. But to understand why, you first need to understand what a pension actually is. And more importantly, when the math started breaking. Because a pension is a promise. You work for 30 years for a state or a city or a school district. And in exchange, your employer promises to pay you a fixed income for the rest of your life after you retire. Sounds simple. And for a long time, it was. Because the model worked on a basic assumption. The money sitting in the pension fund would be invested. It would grow. And by the time workers retired, there would be enough in the pot to honor every promise that had been made. The entire system runs on one number. The assumed rate of return. It's the annual return a pension fund expects to earn on its investments over the long term. And for most public pension funds in America, that number sits somewhere around 7%. Here's why that matters. Because the assumed rate of return isn't just an investment target. It's an accounting input. It determines how much a pension fund needs to hold today to cover its future obligations. If you assume you'll earn 7% annually, you need to set aside less money today. If you assume 4%, you need to set aside significantly more. So the higher your assumed return, the smaller the funding gap looks on paper. And the smaller the funding gap looks on paper, the less pressure on politicians to actually fund the thing. And here's where the lie starts. Because 7% was a reasonable assumption in 1985 when 10-year Treasury yields were sitting above 10%. You didn't have to take much risk to hit that number. You could park money in government bonds and get there without breaking a sweat. But we haven't lived in that world for a long time. Rates spent the better part of 3 decades grinding towards zero. And most public pension funds never updated the assumption to match the reality. They kept the 7% target on the books because lowering it would force a conversation nobody wanted to have. Think about it like this. Imagine you owe someone $100,000 in 20 years. If your money earns 7% a year, you only need to set aside about $25,000 today. But if your money actually earns 4% a year, you'd need closer to $46,000. Same obligation. Very different amount of money you need to hold right now. And if you keep telling yourself you'll earn 7% when you're actually earning 4%, you're not just wrong. You're burning through a gap that compounds every single year. Quietly. On a spreadsheet that most people never read. And that's exactly what's been happening. Because the gap between what public pension funds have promised and what they actually have to pay those promises is somewhere between $1 and $4 trillion, depending on which assumptions you use and which economist you ask. And that range isn't a rounding error. It reflects the fact that the official numbers use the fund's own assumed returns to calculate the shortfall, which is a bit like letting someone grade their own exam and being surprised when they give themselves an A. When you use more realistic return assumptions that reflect where interest rates actually are and where market returns have historically landed over long periods, the hole gets much deeper. And the hole has been getting deeper for years, quietly compounding in the background while everyone argues about the Fed's next move. So what do pension funds do when their investment returns aren't hitting their targets? They have 2 options. 1, they can tell the politicians and taxpayers who fund them that the gap is real and that it needs to be filled with actual money today. Or 2, they can reach for more risk in their portfolios and hope the returns come through before anyone notices. And almost universally, they've chosen option 2. Because this is where the pension crisis stops being a boring accounting story and starts being a market story. Because pension funds have been quietly loading up on risk in a way that most retail investors don't see and most financial media doesn't cover. They've been pouring capital into private equity, private credit, real estate, hedge funds, infrastructure, and increasingly, leveraged alternatives. Asset classes that are illiquid, opaque, and carry significantly more risk than the government bonds pension funds were originally designed to hold. And the reason they're doing it is almost tragically simple. A government bond yielding 4 or 5% doesn't get you to 7%. So pension funds keep moving further out on the risk curve, chasing the return assumption their entire funding model depends on. It's like someone who's behind on rent deciding to put their last paycheck on roulette because a savings account isn't going to solve the problem fast enough. And when hundreds of pension funds are all doing this simultaneously, all chasing the same alternative assets, all competing for the same private equity deals and real estate positions, a few things happen. First, it inflates valuations in those asset classes. When trillions of dollars are chasing the same illiquid investments, prices go up and real returns come down, which means the very move pension funds are making to solve their return problem is part of what's making the return problem worse over time. They're crowding into the same trade. And crowded trades have a way of ending badly. But here's where it gets more uncomfortable. Because the desperate bet isn't just about return. It's also about what happens when those bets go wrong. Because unlike a stock you can sell in seconds, private equity and real estate and alternative assets are liquid. You can't hit a button and exit. Redemption cycles can take months or years. And there are situations where pension funds are forced to raise liquidity fast. A bad investment year. A spike in retirements. A contribution shortfall that can no longer be papered over with optimistic return assumptions. And when that moment arrives, pension funds become forced sellers. And forced sellers don't get to choose what they sell or when. They sell what they can. And what they can sell quickly is the liquid stuff. Public equities. Treasury bonds. The assets trading on exchanges every day. And when a pension fund starts liquidating public market positions at scale, it creates selling pressure that has nothing to do with fundamentals, nothing to do with earnings, nothing to do with the federal. It's just a pension fund in New Jersey or Kentucky or Illinois that needs to make payroll for its retirees and has run out of easy options. And that kind of selling is indiscriminate. It hits good companies and bad ones equally. And it hits at exactly the wrong times, because pension funds are most likely to need liquidity during market stress, when everyone else is already trying to sell. There are roughly 5,500 public pension funds in the United States managing somewhere around $5 trillion in assets. Even a small percentage of that moving into forced liquidation creates meaningful market disruption. Not a single-day crash, but a persistent, grinding source of supply pressure in markets that are already dealing with structural headwinds from every other direction. But the market impact is really just the beginning. Because the second-order effects are where this starts bleeding into everyday life for people who've never thought about pensions once. When a public pension fund is underfunded, the money to fill that gap has to come from somewhere. And that somewhere is the municipal budget, which means the city or the state that sponsors the pension has to increase its contributions, sometimes dramatically. And that money comes directly from tax revenue, which means less money for schools, less money for infrastructure, less money for emergency services, less money for everything else a local government is supposed to provide. The pension obligation doesn't compete with other spending. It crowds it out. Legally, contractually, it gets paid first. And the cities and states sitting on the deepest holes are often the ones that can least afford it. Chicago's pension system is funded at around 20 to 25 cents on the dollar, depending on the fund. Illinois as a whole has one of the worst funded pension systems in the country. New Jersey, Kentucky, and Connecticut aren't far behind. These aren't places with enormous tax bases and room to maneuver. These are systems where the pension contribution is already eating a meaningful percentage of the annual budget. And as the underfunding grows, the crowding out grows with it. And at some point, the math stops working entirely. Because municipalities fund themselves through the bond market. They issue debt to cover expenses, fund projects, and manage cash flow. And when a city's pension obligations are growing faster than its tax base, credit rating agencies notice. Borrowing costs go up. The cost of everything the city finances goes up with it. And in extreme cases, you get what happened in Detroit in 2013, the largest municipal bankruptcy in American history, where pensioners who had worked their entire careers, teachers, police officers, firefighters, ended up with cuts to benefits they'd been promised for decades. Not because the city wanted to break those promises, because the math had been broken for so long that there was nothing left to honor them with. Detroit isn't a cautionary tale about what could happen. It's a preview of what the math produces when you let the gap compound long enough without ever addressing it. And here's the part that should make you uncomfortable regardless of where you live or what you do for work. Because this isn't just a problem for the cities and states directly exposed. It's a problem for anyone invested in U.S. markets. It's a problem for anyone who pays federal or state taxes. And it's a problem for anyone counting on markets to function in an orderly way during the next period of stress. None of this is a secret. The data is public. The funding ratios are published every year. The assumed return assumptions are disclosed in financial reports that anyone can read. This isn't buried. It's just boring. And boring doesn't trend. Which is exactly why traditional financial media isn't covering it. Because a trillion-dollar funding gap that unfolds over decades doesn't have a villain. It doesn't have a single moment of crisis you can put in a headline. It's a slow-moving problem that becomes everyone's problem gradually, and then suddenly. And by the time it becomes suddenly, it'll already be priced into everything. And it'll be too late to be early. The loud risks in markets are almost always priced in by the time everyone's talking about them. The quiet ones, the ones that require patience and more than a 60-second attention span, those are the ones that catch people off guard. And that's exactly why I made this channel. To cover the stuff that doesn't trend. The stuff that actually matters. So if you want to understand what's really moving underneath the surface of markets and the economy, hit subscribe. Because I promise you, the pension system is not going to fix itself. And the longer nobody talks about it, the worse the eventual landing is going to be.